Anna Mitchell here with your Money Chat. This week, the minutes from March 16th Fed meeting were released showing that the Fed would have likely hiked by 50 basis points in March if it were not for Russia and Ukraine conflict. Many participants noted that one or more 50 basis point hike could be appropriate at the future meeting, which will likely occur in May with inflation going so high. Now, it's expected that the CPI will rise from 7.9% to 8.4% this week. Now, the big news was their balance sheet. Most agree that when they begin to reduce their balance sheet, monthly caps of $60 billion for treasuries and $35 billion for mortgage-backed securities would be appropriate. This is a total reduction cap of $95 billion per month. Now, they also agree that the caps would be in a phased over period of 3 months or longer if warranted. This means that they will start to reduce their balance sheet at a lesser amount, but will eventually get up to the $95 billion reduction over time, much like they've done in the past. Now, last time the Fed reduced their balance sheet, they started with a reduction of $10 billion, $6 billion in treasuries and $4 billion in mortgage-backed securities, and scaled up to $10 billion every 3 months until they ultimately hit $50 billion run off for the year. Now, in today's case, they are planning on getting to 95 billion in just 3 months or so, which explains some comments that we heard from Boehner on the rapid reduction. Now, when we look at the Fed's mortgage-backed security purchases, at the Fed's peak, they were buying 40 billion outright and another 7 billion in reinvestments from their holding for a total of 11 billion per month or 1.3 trillion over the course of a year. Now, we heard from St. Louis Fed President Bullard, who has been extremely hawkish. He said that he thinks that the Fed's fund rate should be at 3.5%, which is a big jump from the current range of 0.25% to 50%. We will also hear from New York Fed President John Williams. He is one of the most influential members of the Fed. The New York Fed is also where all of the mortgage-backed security purchases go through. So the markets are going to be listening really closely to his comments, especially with all of the talk on the balance sheet reduction. Now, initial job claims, which measures individuals filing for unemployment benefits for the first time, decreased 5,000 to 166,000, which is the lowest reading since 1968. Now, the previous report week's numbers was revised lower significantly by 31,000 from 202,000 to 171,000. Continued claims, which are those that continue to receive benefits after their initial claim, decreased 17,000 to 1.5 million. Now, while these numbers look exceptionally low, there was a new methodology the BLS started to use, which rejiggers their seasonal adjustments over the past 5 years. This resulted in some big revisions, lowers to the figures, but remains to be the same, that employers are holding on to their workers and firing less, and the labor market is extremely tight. Now, the global economy is interconnected. There are already signs of a potential recession in Europe. Their April Eurozone Senex Confidence Index fell to a -18, and many are saying that we will look back at the start of Q2 as a recession in Europe to retrospect. Now, while this is a sentimental index and not hard data, it tells us that people are thinking and what they're thinking in Europe. This is important as the global economies, again, are interconnected. And rarely do we see a recession in one country, but rather widespread recessions at the same time. And speaking of recessions, the indicator that I've been following is the U.S. 10-year and 2-year Treasury note yield spread. After inverting for a period of time last week, the spread is inverted once again to a -3 basis points. Now that we have seen an inversion, what does that mean for our economy? If this indicator holds true, how long until we see a recession? Well, it's not going to be tomorrow, but looking at history, you can see that after the last 5 inversions took on an average of 11 months until a recession. Through modern history, the average is 20 months. Now, it seems that time is getting a little more compressed and things are happening more quickly. Removing the 1998 recession, which appears to be a bit of an anomaly, the average time till recession is between 5 and 6 months. months. Now, if this means that we will see a recession over the next year, what does that mean for equities? Well, interesting. The NASDAQ returned from inversion to recession the last 5 times was on an average of 50%. Now, removing the 1998 recession, which had an abnormal high return, the average of 17%. Also interesting is the 2 months following the recession. The NASDAQ was positive every time for an average of 6.68% return. This tells us that while we may be heading into a recession, it doesn't mean that we have to panic immediately on our investments, as you can still see gains until the peak and the recession. Also coinciding is that in April has been the best month for the S&P 500 over the last 30 years, from 1992 to 2021. On an average, there has been a 2.34% total return. Now, November is the second best month over the period of time, averaging at 2.03% return. We'll have to wait and see what unfolds for the markets. Tina Mitchell, and that is your Money Chat.